And welcome to Hashtag. I'm Mil Arcega. Thank you for joining us. Well, you know, after a year of fits and starts, it's beginning to look a lot like an economic recovery may actually be taking hold in the United States. That's a sentiment, of course, confirmed in part by the central bank's decision to raise interest rates for the first time since the financial crisis. But as you'll probably soon find out, the outlook for the global economy is not quite as clear. The big story as 2015 comes to a close was the Federal Reserve's decision to raise its benchmark lending rate by 0.25%.
And it reflects the committee's confidence that the economy will continue to strengthen.
Despite ups and downs early in the year, U.S. growth appears to have stabilized, and unemployment is at a 7-year low. Ratings agency Standard & Poor's is looking at 2.7% growth in 2016, and something the U.S. has not seen in more than 7 years: full employment.
Good news, we are seeing improvement, and we do expect to see, as the economy gets stronger and stronger, we do expect to see that unemployment rate dip down a little bit lower, closer to 4.6% by year-end next year.
But the outlook for the global economy is a bit murkier, according to the National Association for Business Economics.
The outlook around the world is probably for less growth than the U.S. has been experiencing, at least among developed nations.
A UN report on global economic prospects sees continuing headwinds around the world, especially in emerging markets, which once attracted investors seeking higher rates of return. Here's Gus Fauché, economist at PNC Financial Services, on Skype.
I think that it is going to be more difficult for emerging markets. They're much more subject to big capital flows in and out. So there could be some dislocation there as the Fed starts to raise rates in the United States.
And as 2016 begins, persistent worries remain regarding slower growth in Europe and in China. Despite the uncertainties, most economists say warnings about a potential worldwide recession are exaggerated.
Obviously, things go wrong. We see certainly worries in the Eurozone, softness in China, all these things suggesting that it will be a bumpy road ahead. But I don't necessarily say that suggests a recession is imminent.
Despite an improving U.S. outlook, the rising value of the dollar is likely to hurt exporters in 2016. Even as plunging oil prices reduce global energy investments. So there you have it. Now, before I introduce our distinguished panel, let's take a quick look at what people are saying in social media about the economy. And for that, we turn it over to Andrew Palczewski. Andrew, what's up?
Thanks very much, Mil. Back to you, Mil.
All right. Thank you, Andrew. And with that, allow me to introduce our panel, and we are lucky to have them. In our Washington studio, we have Dr. C. Fred Bergston. He's an American economist and founding director of the Peterson Institute for International Economics. In our New York studio, Carlton English is a writer and analyst covering banking and Wall Street for TheStreet.com. And from our New York City remote, Beth Ann Bovino is the chief economist at ratings agency Standard & Poor's. Welcome to all three of you. Thank you so much for joining us.
Great to be here.
Beth Ann, you were in that package, so let me start with you. You know, the economy in 2015 was a lot like taking 3 steps forward and then 2 steps back. So looking back now at 2015, how would you describe the year that was? Why was it such a roller coaster ride?
Well, I think 2015 was just another roller coaster ride, because remember, this is also what we've seen throughout most of this recovery. Mm-hmm. 1 step, 2 steps forward, 1 step back. I think that what was good to know in terms of, despite all the volatility, that we did see a trend higher. Some of the strengths, and particularly what we'd like to focus on, is the domestic side of the U.S. economy seems to be holding up. Jobs are coming around again, still bumpy, but now we're looking at 230,000 job gains or more for the year, which is pretty nice news. And we are starting to see slow signs that wages are picking up as well. So that's something that we're watching, certainly, and hopefully we'll see that go forward into 2016.
So the year is ending on a pretty good note, right?
Yeah, we're not surprised. We have been expecting the Fed to raise rates actually since August. Okay. We thought that they'd want to slow down, and again, the reason why they slowed down was worries from abroad. What's happening with the Eurozone, the risk of a recession in the Eurozone, and of course the worries in China as well. And that was one of the reasons why.
Yeah, we'll talk about all those things.
Slow down.
Right. Well, let's talk about all those things coming up in the second segment. But Carlton English, I want to get you involved in this. Now, from Wall Street's vantage point, how did the markets do this year? What kind of year has 2015 been like for investors?
You know, I think 2015 has been a little bit bumpy for investors. You know, we are certainly seeing that upward trend that Beth Ann mentioned earlier. But you know, when you look at the the price of oil, you know, that has depressed the markets. You know, in recent months, especially, even though there has been a bit of an upward trend. So, you know, if you're looking at individual stocks, I think that there's a bit of a roller coaster ride effect. But you know, more broadly speaking, I think it has mostly been a positive year for the S&P.
And Dr. Bergston, you know, watching the economy and seeing trends and looking back and looking ahead has always been your expertise. You've been following this for quite some time. But I think a lot of people have found the recovery since 2008 frustratingly slow. You know from your experience that previous recoveries have not been quite as slow. What gives? Why has this recovery been slow?
Well, the basic point first is that the U.S. economy is in very good shape. It's been growing for 6 years. It's, in fact, one of the longest recoveries we've ever had. It's been slow but steady, no inflation. I think no big imbalances now. So I think it's been good, and I think the outlook continues to be good. The reason it's been slower is that it's the recovery from a financial crisis. The fact that the recession of 08-09 was driven by financial problems, the housing bubble, all that, meant that debt buildup. The debt buildup was huge in households, in corporates, in government, and it simply takes a long time to unwind that debt overhang to restore balance sheets to a point where more normal investment patterns, consumer patterns, growth patterns can be restored. So it's longer, but it's also steady, and I think it's laid the base now for continued pretty positive growth at a very constructive U.S. economic outlook.
It also forced us to take some very unconventional measures, right? But as you know, inflation was always sort of the obstacle for the Fed raising its rates. I mean, for most of our economic history, inflation has always been sort of a bad word. Why is inflation important in this case?
Well, the Fed's problem has been to get inflation up, not to hold it down. And the problem there is the risk of deflation. If prices start to actually decline, then debt problems become bigger. Consumers hold back spending even more because they think prices may get even lower. So it's a negative spiral. That's what Japan has been in for almost 20 years. Japan is a classic case of what to avoid. They let themselves get into a deflationary spiral. That also means monetary policy is not very effective. You can reduce interest rates to zero, you can do quantitative easing, but you're really hamstrung in terms of your policy responses, particularly if you go in with a big debt overhang in government. Right. So fiscal policy is limited. So you want to avoid deflation, and that's why the Fed has been eager to get inflation up, at least close to its 2% target. It's still got a ways to go. That's another reason why I think they will go very slowly, very gradually in raising interest rates. I think that's going to be a non-event, actually, over the next couple of years.
That's reassuring to hear. Beth Ann Bovino, before we go to break here, of course, the much-anticipated rate hike was on everyone's mind last week. I had all sorts of people coming to my desk asking me, should I refinance my mortgage? Should I change credit cards and all that stuff? But it's a 0.25% rate hike. I mean, what impact is that really going to have on anyone?
Well, we think, I mean, you know, going up always is going to increase borrowing costs, but we're talking rather small. We're talking 25 basis points. In terms of where the mortgage rates are, for example, the mortgage rates, I believe, are around, for a 30-year fixed, is probably around maybe 4.5%. Put it into perspective, historically, the normal, the average would be about 6%, and maybe a peak of around, you know, maybe going up to 8% on average going back. So we're well below what is the historic norm. If the Fed raises rates as we expect slowly into next year, we're looking at maybe 1.25 or 1.5 by year end. That's where the Fed used to bring interest rates down to during a recession.
All right. We're going to take a quick break right now because we're out of time for the first segment. But when we come back, I'll ask our experts about where the global economy is headed. This is #VOA. We'll be right back. And welcome back to #VOA. I'm Mil Arcega. And let's get back to social media now with Andrew for another quick look at how the economy is affecting people and their pocketbooks. Andrew?
Thanks, Mil.
Just got to buy. Keep spending out there. This is, after all, a consumer-driven economy. Thank you, Andrew, and thank you, Ed. But in this segment, I want to take a closer look at how the global economy is shaping up. And to help us with that, let me reintroduce our guests. We have Dr. C. Fred Bergston for the Peterson Institute for International Economics in New York, Carlton English with Street.com, and also in New York, economist Beth Ann Bovino, Standard & Poor's chief economist. You know, most of our audience, Dr. Bergston, lives in emerging economies outside of the United States. And I guess for many of them, what is happening in the United States has some significance in how their economies operate. What do you see as the major trends developing in emerging economies right now?
Well, I think it's a major mistake to generalize about emerging economies.
Okay.
They are very differentiated.
Sure.
People worry about a slowdown in China, but it's still going to be growing at 6 to 7%, in my view, toward the higher end of that range. It'll still be a big driver of global growth, more than the United States.
But a driver in an L-shaped kind of growth.
Well, as long as China's growing at 7%, and it's got an economy now that's more than half the size of the United States, it's providing bigger impulse to global growth than we, who are growing less than half as fast.
Right.
Simple mathematics. India now is growing faster than China, probably in the 7 to 8% range this year. And if they can get their economic reform package going, they could get up into the 8 or even higher percentage range over the next several years. So there are big emerging economies, in fact, the two biggest emerging economies, that I think are looking very good. You can either think of them as islands of stability in an otherwise shaky world, or, as I prefer to, think of them as pulling up the Asian economy as a whole.
You're talking about India.
China and India as huge drivers of Asia, which is the biggest share of the world economy as a whole, the fastest growing share, the biggest driver of world trade. As long as that engine continues to churn forward, it's very hard for me to see any significant downside risk for the world economy as a whole.
Well, there are some fears that because of various headwinds that are sort of floating around out there in the ether, that there are some who are warning that there's a possible global recession coming up. Have you heard any of those kinds of rumors, Carlton? What is the street saying when it comes to the impact of the imbalance here? We've got the United States sort of growing quite steadily and quite a few problems going on in Europe and a slowdown in China and all that. What are you hearing in terms of possible challenges facing us in 2016?
Sure. You know, there's a lot of people who have mentioned the possibility of a global recession, but almost as soon as those concerns are raised, they're quickly debunked by another person. So I think, you know, you may be looking at maybe a slight global slowdown, whether it's to the degree of a recession, I think maybe slightly overstated. You know, and also to the point of a slowdown in China, you know, like we said, their GDP growth is looking to be around 7%. That's enviable from the perspective of the U.S. right now. And I think, you know, they're in such a long process of modernizing that seeing, you know, a high single-digit growth, it's just part of that process after we've had, you know, years of double-digit growth.
Beth Ann Bovino, we haven't even talked much about low oil and commodity prices, and that's bound to have an impact in 2016. Who's mostly affected by these low oil and commodity prices, and what impact do you see moving forward?
Sure. 2015, just let's look at 2015. While the domestic spending held up rather well, where were the weaknesses? One in particular was that drop in oil prices. If you look at the first quarter readings of business spending, which we hope will actually pick up, a lot of that, almost over half, was largely because energy companies, faced with losing half their revenues because oil prices fell from $100 a barrel thereabout to now it's well under 40. They lost half their revenues. They cut back on investments. They cut back on hires. You saw an amazing drop in terms of equipment spending. In terms of business, in terms of energy companies, again, that's still likely going to be felt into 2016. And where do we see that? From North Dakota all the way down to Texas. The weakness is there. That spreads into what you could imagine would be energy-related businesses for manufacturing, who also got a double whammy by the drop in oil. The jump in the dollar as well. These factors are something that certainly will weigh on the energy sector, which is certainly hurting the U.S. economy. But given that the energy sector is still rather small, I think value added, it makes up maybe 2.5% of the overall economy, still rather small, it is felt. And we do see that continuing into 2016 as a weight. Put it in perspective, though, as many other people, as many other Americans go to the gas pump and enjoy that $2 a gallon gasoline, they actually have a little bit more purchasing power to spend at the mall. So net on net, it's been rather good for the U.S., but not as much as we would have seen earlier.
It's been very bad for Russia's economy, though, and a lot of oil producers.
Yeah, but we have to remember that lower energy prices are unambiguously great for the world economy. They're the biggest stimulus we could have possibly imagined, and they're one factor that's keeping both the U.S. and the world economies growing rapidly. Now, they have distributional effects. The Russians lose, the Saudis lose, the Venezuelans lose, U.S. oil shale producers lose, but that is more than offset by the net reduction in consumer costs, the stimulus to investment in other sectors, the anti-inflation effect that makes it easier to keep interest rates down and monetary policy expansionary. So on balance, all studies show that lower energy prices are a boon for the world economy, and in fact something we ought to welcome.
In the minute that I have here, as you know, the White House is calling the upcoming trade deals that are still before Congress right now as win-wins. Of course, much of it depends on the political situation here in the United States. What is a Trans-Pacific partnership a win-win for the United States? As you know, there are a lot of critics to that.
The Trans-Pacific Partnership is a huge win for the United States. Our studies show that the U.S. economy will be $100 billion per year richer as a result of the Trans-Pacific Partnership once it phases in. However, there is a lot of opposition, as you say, because there are distributional effects. There are some losers. There are some people who will lose jobs in the U.S. economy because we open up more to imports from the TPP partners. In terms of the overall economy, that's more than offset by the lower prices to consumers and the big export gains that we get from opening up foreign markets, which have been much more restricted than ours. So it's a big net win. But in this case, the costs are highly concentrated, particularly in some labor groups who oppose the agreement politically, and that's going to make it a hard sell. I think one of the big risks for 2016, in fact, is that the Congress might not approve, might just defer, delay, not act on the Trans-Pacific Partnership and the follow-up agreement with Europe. And that could have a very negative effect on confidence because everybody assumes in markets and the economy, everybody assumes we're in a globalized economy where markets are basically open, where markets are interconnected and globalized. If those assumptions get shattered or even questioned in a serious way, that could have some deleterious effects. So I think that's one of the possible dark spots and wild cards, you might say,
it's
for
part
2016.
of the evolution of the globalized economies. But we're going to take a quick break right now. When we come back, closing comments and predictions on the global economy for 2016. We'll be right back. And welcome back to #VOA. I'm Mil Arcega, along with my co-host Andrew Palczewski. Well, you know, it's been an interesting discussion so far. I wish we had a lot more time. We're talking about the global economy. But for this final segment, I'd like to ask our panel what might be in store for us in 2016 and also around the world. And to help me and Andrew out, we are joined again by in our D.C. studio by C. Fred Bergson, founder of the Peterson Institute for International Economics. In New York, we have Carlton English from TheStreet.com, and from Standard & Poor's headquarters in New York, Beth Ann Bovino, chief economist at Standard & Poor's. Beth Ann, we haven't talked much really about what's going on in the Eurozone. As you know, the last couple of years has been marked by lots of ups and downs, the debt crisis, the protests, the lowering of the euro. What's in store, do you see, for the European Union in 2016?
Well, it seems like, I'm a U.S. chief economist, so speaking from what our European economists are saying, we see some stabilization in the Eurozone. It looks like growth is improving as we go into 2016. We do expect to see, we're looking for growth, I believe it's looking at over 1% for 2016, really driven particularly by what's happening with Germany. That's the real motivating factor, but we're seeing strength from other regions as well. One thing that's actually a support is the ECB continuing with quantitative easing, now going going into 2016, that's actually one support. It also puts upward pressure on prices in the Eurozone. They were at risk of going into a deflationary spiral, as talked about by Fred. That seems to be less kind of pushed off a little bit further, a positive for the Eurozone.
And Andrew, I know you have a lot of questions to ask, so
Yes,
go for it.
I'll distill it down to one for Carlton. We heard from what the people were saying on social media. This touches on a lot of issues, and we're looking forward to 2016. So what do you think will be the next hashtag that kind of encapsulates all this? It's hard to maybe stick it into one, 140 characters or less. But where do you see the conversation going next year?
Sure. I think the beginning of the year is definitely going to be tilted towards energy prices. There's going to be the regional effects of domestic oil producers that have been suffering. I think the next rate hike, there might be some jitters around that. But I think the big one is going to be this election cycle. As we progress into the year, whatever the topic is, whether it's, like in 2008, Wall Street reform, or whether it's looking at maybe the effects of low energy prices in our domestic economy. Whatever it is, I think the next discussion about the economy will be shaped by the U.S. presidential election.
Dr. Bergson, part of the discussion obviously is going to be the high dollar exchange rate. Obviously, that's already having some impact in some foreign markets. What do you see for foreign exchange stories coming up in 2016? Is that something that the emerging market economies will benefit from or be a disadvantage to them?
Well, for the emerging markets, it's a mixed bag. I think the dollar will go up considerably further over the course of the next year. U.S. economy will be growing faster than Europe or Japan. Interest rates are moving up, albeit slowly here, whereas the monetary policy is still in an easing mode in Europe and Japan. So I think the dollar will go up more. That'll be a drag on U.S. economic growth, and it may add to some of those trade pressures in the Congress not to open our markets and liberalize further. But I think the basic story for 2016 is good for the world economy. The four biggest economies in the world are all going to be doing well. The United States, Germany, China, and India. I think all of them will be doing well. They'll be growing at paces that are quite high by their own standards. They'll pull up their own regions. I don't think there's any risk of a world recession. I think there's very little risk of inflation picking up. So call it slow and steady, but in a sense, slow and boring is good for the economy and for markets. And I think 2016 looks like a good year.
So a large part of our audience obviously live in the African continent. It's the fastest growing in terms of population, in terms of economic growth. What do you see happening in the various countries in the African continent?
Well, I'm glad you mentioned Africa. I think it may be the next new growth story. It's already picked up quite a lot. There are, 12, 15 countries in Africa that are already growing very rapidly, have been doing so for 10 years or more. The whole continent, with its population growth, good demographics, look to me like maybe the next big growth engine of the world economy over the next decade or two. So that's a further impetus to the kind of positive global outlook that I would see this year and going forward for the medium term.
Carlton English, I got about 15 seconds. What kind of a year do you expect for Wall Street in 2016?
Well, I'm hoping for a good one. I mean, that's what I can say right now. But, I've been knee-deep in this energy story recently, and, it is going to weigh on the economy. All
right, well, we'll be watching your reports. Thank you so much to all of our guests, Dr. Fred Bergsten from the Peterson Institute for International Economics, Carlton English at TheStreet.com. Thank you so much. And Beth Ann Bovino with Standard & Poor's, thank you for your contributions. In the meantime, visit our website at voanews.com, #VOA, and please tweet us with your comments and your questions at #VOA. For Andrew and all the team here at Voice of America, we wish you all a Happy New Year. Thank you for watching.